Hi, I'm Jeff Tucker, Principal Economist at Windermere Real Estate, and I'm back with my housing market predictions for the coming year. Yogi Berra famously said making predictions is hard, especially about the future, but we've still got to try. Here are the 6 trends I'm predicting for 2026. Number 1, existing home sales will pick up barely. Home sales have hovered near generational lows for 3 years running now. Going into 2026, there isn't much reason to hope for a sharp rebound, but the pieces are in place for a very modest climb in existing home sales. Those pieces are higher inventory than we've seen since 2019 and lower mortgage rates than we've seen since 2022. That combination should be enough to spur somewhat more home sales next year. But the evidence from late 2025 suggests any such gains will not be very large. Number 2, home prices will be roughly flat. Nationally, home prices did grow barely in 2025, but I expect them to stay roughly flat in 2026. The main reason is much higher inventory. Some pent-up supply by sellers who couldn't put off selling any longer has been putting downward pressure on prices. In fact, the Case-Shiller Home Price Index saw some negative moves in seasonally adjusted terms last summer, but that trend ended this fall. So why don't I expect prices to fall much at all? Sellers have shown they're responsive to market conditions. As the market swung in buyers' favor, many homeowners who didn't get the offers they wanted simply delisted their homes, while others decided not to list at all, helping to slow down the breakneck pace of inventory growth from early 2025. Number 3, inventory will climb to pre-pandemic levels. Inventory, or the number of active for-sale listings, is likely to finally return to pre-pandemic levels nationally at some point in 2026, maybe as early as the spring selling season. It climbed substantially in 2025, and the number of canceled listings suggests some shadow supply of homes people would like to sell, but are waiting until they judge the timing to be more favorable. Moreover, I think we'll see a repeat of the trend of discretionary sellers, people trying to sell a home, but only if they get the right price. That willingness to test the waters and hold out for a good offer should push up average time on market, which increases the number of listings available at any point in time. Higher inventory will give buyers a better chance of finding a good fit, and some more leverage at the negotiating table. Number 4, the homeownership rate will decline. At today's interest rates and prices, homeownership remains out of reach for many middle-class Americans who want to be homeowners and who would have bought their first home in different conditions. Meanwhile, rent growth has slowed sharply, so many of those people are content to bide their time and continue renting. A big part of this trend will be more people renting in single-family neighborhoods, as many folks who want to live in a house like that are no longer waiting around until they can qualify for that first mortgage. Number 5, we will avoid a recession in 2026. The US economy withstood several negative shocks in 2025, which left it wobbling but still standing. Yes, payroll gains have slowed to a crawl, but that seems attributable to shrinking labor supply as much as falling demand from employers. And we never saw a big rise in unemployment claims. After all the turmoil about trade policy earlier in the year, we've now seen US companies beat their earnings estimates in jaw-dropping numbers, while mentions of tariffs and trade concerns have become less frequent. Now the outlook for tariffs seems to point toward growing relief between court challenges and a drumbeat of new trade deals being announced, easing some of the costliest tariffs that were imposed earlier in 2025. Number 6, mortgage rates will decline slightly. Interest rates on 30-year mortgages will likely stay at or below 6.25% for most of 2026. The Fed's shift to a rate-cutting cycle, paired with slower economic growth, has brought 10-year Treasury yields down closer to 4%, while the spread, how much higher mortgage rates are, has gradually shrunk back towards its normal range below 2%. I think that process will continue as the refinance risk on mortgage-backed securities gradually fades. Nevertheless, premature hopes for falling mortgage rates have been dashed repeatedly since 2022, so no one should bank on rates dropping dramatically in the year ahead. So to sum it all up, I'm expecting a mostly stable year with some gradual modest improvement on the most important housing market metrics: inventory, sales, and mortgage rates. I hope you enjoyed my predictions for 2026. Be sure to follow Windermere Economics on Facebook and Instagram to stay up to date year-round on the housing market.